It would be so awesome, right, if we were just sitting around and having a conversation about Schedule D line by line instructions, how to report capital gains and losses. Well, guess what? You are at the right place at the right time, so stick around and don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic because I'm doing marvelous. If you are doing as superb as I am, go grab a cup of coffee or tea or vodka and let's roll. Today's conversation will be very interesting because we're going to cover one of the most pivotal topics that a lot of millions of Americans right now care about, and that's Schedule D. So before I get into the nitty gritty, I just want to give you, if you say you just want the gist of today's conversation, here it is. Here are the key takeaways. If you don't have 10, 15 minutes to listen to the whole conversation, here is the 1 minute nitty gritty you need to pay attention to. You have a capital gain or loss when you sell a capital asset for more or less than you paid for it. And capital assets include investments and most personal property, such as your primary home, right? And short-term capital gains, in other words, those that you own for 1 year or less, are taxed like ordinary income, but long-term capital gains, the one that you own for more than a year, they have much lower tax rates. So when you sell your home, you can exclude up to $250,000 of the sale price from capital gains, and this is $500,000 for joint filers. So when we talk about Schedule D, we're talking about capital gains and losses. All right. So there are two types of capital gains, and the tax rate you pay depends on how long you hold an asset before selling it. All right. So when a Schedule D is needed, when is it needed? In general, taxpayers who have short-term capital gains, short-term capital losses, long-term capital gains, or long-term capital losses must report this information on Schedule D. And this is an IRS form that basically accompanies Form 1040. All right. So when you talk about Schedule D, you have to automatically talk about Schedule D. And Schedule D is not just for reporting capital gains and losses from investments. It's also used to report capital gains or losses from ownership in a partnership, as corporation, estate, or trust. Also, taxpayers who have capital loss carryovers from previous years use Schedule D to report this information. So if you using tax software, you can actually make things very easy. You can figure out whether a Schedule D is required and completed if so. So you don't really need to do things manually. But I'm still explaining to you how the whole thing goes so you understand what the software is doing, or you really understand how to respond if the IRS were to contact you. Okay, the IRS distinguishes between short-term capital gains or losses as those held less than 1 year and long-term capital gains or losses as those held longer than 1 year. And one thing that I really want to mention before moving on is that only short-term losses can be used to offset short-term gains and long-term losses for long-term gains. So losses that are recorded that exceed any gains may be eligible to be carried forward and applied to the next year's taxes. Okay, I've been talking to you about capital asset. What is it really? What is a capital asset? Let's just go back to the capital asset 101. So most of the property you own and use for personal purposes, as well as most investments, are classified as capital asset. So they include your home, primary residence, your personal car, stocks, bonds, and other investments, but likely not retirement accounts, personal property like clothes, furniture, and appliances, valuables like jewelry, gems, gold, silver, and other metals, collectibles such as an art, coin, or stamp collection, real estate as long as it's not a rental property or used for business. And business income, business property, and business inventory are not considered capital assets for your personal income taxes. Okay, because this includes items you buy for the purpose of reselling. For example, let's say if you buy an old camera at a yard sale for the express purpose of reselling online, it is not considered a capital asset. It is business inventory. And if you have enough of this side income, you may need to pay self-employment tax, and estimated quarterly tax payments. Okay. And one thing that's very important to mention also is that capital assets do not include things like patents, copyrights, inventions, phone apps, or secret formulas. They also don't include artwork, musical compositions, letters, literature, photographs, computer code, or similar items. As long as you created them, they were made for you, or you had gifted them by the creator. Okay. And you may also see capital asset called fixed assets when talking about business property. So the term property, plant, and equipment, PPE, may also refer to a business's capital assets. All right. Now, capital gains tax on real estate. This is an interesting topic here. When you sell your home, I think I've already said that earlier, you can exclude $250,000, and the amount is $500,000 if you file a joint return, and you can exclude that amount from the sales price when calculating your capital gains from the sale. Let's say you sold your home for $300,000, your capital gains would only be $50,000 if your filing status is anything other than married filing jointly. A joint filer wouldn't have any capital gains from this sale. So to qualify for this exclusion, you must have owned the home for at least 5 years, and during the 5 years before selling your house, it must have been your primary residence for at least 2 years. And this home exclusion is also referred to as the Section 121 exclusion. All right. Let's now talk about short-term versus long-term capital gains and losses. Now, there are two groups of capital gains. I was actually alluding to it a little earlier. Now, I'm going to actually go a little deeper here, right? And there are two types of capital gains. So you have short-term and long-term. So which type you have determines the tax rates you pay. So short-term capital gains, those are any capital assets. The short-term capital gains are any capital asset you own for 1 year or less before selling, 1 year or less. And those gains, the short-term gains, are taxed as regular income by the IRS, which means they are added to your annual work income, and you pay the regular federal income tax rate, which actually range from 10% to 37% in 2020 and 2021. So the initial section of Schedule D is actually used to report your total short-term gains and losses. So any asset you own for 1 year or less at the time of the sale is considered short-term by the IRS. Very, very, very simple. Let me give you an example. Let's say you purchased 100 shares of Tesla stock on May 1st and you sold them on September 15th of the same year. You report that transaction on Schedule D and Form 8949 as short-term. When your short-term gains exceed your short-term losses, you pay taxes on the net gain at the same ordinary income tax rates you pay on your other income, such as your wages. And then we have a long-term capital gains. So for the long-term capital gains are actually a capital asset that you own for at least 1 year before you sell them, okay? And those gains receive preferential tax treatment, and you actually pay lower rates compared to standard income tax. So the long-term capital gains tax rate is 20% or less. So it hovers between 10%, 15%, and 20%. So capital assets that you hold for more than 1 year and then sell are classified as long-term on Schedule D and Form 8949. Okay, and the advantage for reporting a net long-term gain is that they generally are taxed at a lower rate than short-term gains. There is one exception to note if you have any ownership or financial interest in a partnership. So starting in 2017, you must hold what the IRS called quote-unquote applicable partnership interest for more than 3 years before they are considered long-term capital gains. So any applicable partnership interest is ownership or other financial interest that you receive from a partnership in exchange for services you provided. Okay, now let's talk about the tax calculation of capital gains and losses. The gains you report are subject to income tax, but the tax rate you will pay depends on how long you hold the asset. That is pretty clear now. Now you understand that. And if you have a deductible loss on the sale of a capital asset, you might be eligible to use the losses you incur to offset other current and future capital gains. And basically, certain assets can have what the IRS calls adjustments to the basis that can affect the amount gained or lost for tax purposes. Okay, so what is the tax basis? The tax basis is the difference between what you bought the asset for That's the basis. And what you sold the asset for, the sale proceeds. And I want to talk to you about the capital gains tax rates in 2020 and 2021. First of all, it's very important to understand that the capital gains tax rate only applies to long-term capital gains, right? Because short-term gains are taxed as ordinary income, just like the rest of your income for the year. That's pretty clear. That's pretty clear now. And there are 3 capital gains tax brackets. So you have the 0%, 15%, and 20%. In some cases, we've seen also 10%. So similarly to the ordinary tax bracket, you only pay a given tax rate for the capital gains income that falls within the rate's income brackets. So as an example of how the capital gains tax rates work, let's say you are a single filer who is reporting, say, $45,000 of capital gains income on your 2020 taxes. Okay, you would pay 0% tax rate on the first $39,375 of your gains, and then 15% tax rate on the remaining $5,625. And if you have more than a certain amount of capital gains income, you may also have to pay something called an additional net investment income tax, the NIT, the NIIT. And the NIT rates are provided here on the screen. Just look on the screen right now. We're showing you on the screen. You have the net rate, so we have the 2020 capital gains tax rate. And we have 2021 capital gains tax rate. And then I'm also showing you after that, so I'm showing you 3 tables here. The third one is 2020 and 2021 net investment income tax threshold. So I'm first showing you the capital gains tax rate and then the net investment income tax threshold. All right. So the thing here is that capital gains income above a certain threshold is also subject to a 3.8% tax called the NIT, I think. And the NIT applies to individuals, estates, and trust. And the NIT rate and income threshold are the same for 2020 and 2021, as you can see it. But they do vary, though, based on your filing status. And the income threshold is also determined by your modified adjustment. Your modified adjusted gross income, your MAGI, not your total income. So if you have a more question about the NIT rate or your own personal NIT, then you want to go and read Form 8960. That's the form you have to actually pay attention to, 8960. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We are having a conversation today about Schedule D, and I'm going to give you line-by-line instructions. But before I do that, I just want you to understand the whole topic here. All right, what the Schedule D is for, and what are the pros and cons, and what are everything that goes around that schedule. So, how to report capital gains on your taxes. You reporting capital gains on your tax return will most likely require you to fill out and attach at least 2 forms to your Form 1040. So you have to do Schedule D, of course. This is very important, and the rest will depend upon your situation. I'll give you an example. Different kinds of capital gains also have their own tax forms that you need to complete. For example, you need to use Form 4684 to report capital losses due to casualty or theft. So you want to make sure you attach all the forms you use to your tax return. So you want to gather all the documents. There are 3 common forms you may receive from your broker. So you have Form 1099B. This is proceeds from broker and barter exchange. This shows capital gains or losses from investments. You have Form 1099S. This is proceeds from real estate transactions. This shows capital gains or losses from selling property, including a home. And then you have Schedule K1. This is a partner's share of income, deductions, credit, etc. for gains or losses you received from a partnership, S corporation, estate, or trust. One thing I want to say here is that all those forms that I'm just talking to you about can be sent to you at the end of the year electronically. We live now in the digital era. You don't have to receive a paper package, if you will, in the mail from your broker. They can send they can make those forms, those 1099 forms available to you digitally, and you just have to download it. And if you have the right software package, You basically can export the data from the broker's platform onto your tax software, whether it is H&R Block, TurboTax, Tax Act, Credit Karma Tax, and so on and so forth. Okay, and I want to quickly talk about Form 8949. So you want to complete Form 8949, sales and other dispositions of capital assets. If you want to, let's say you have done, like, you want to write what each capital asset is, the date you acquired it, the date you sold it, your purchase price, your sales price, and most importantly, your final net capital gains or losses. And then we have Schedule D, right? So after filling out Form 8949, you need to complete Form 1040 Schedule D. And Schedule D is where you actually calculate how much tax you owe on your capital gains. And the form has 3 parts. I'll go in depth later on, but this is something that you really need to do. And there are other forms you may need. Certain types of investments or capital gains or losses will require you to complete additional tax forms and attach them to your tax return. And some of the most common forms are listed on the screen right now, and you will need to complete this to fill in your Schedule D. So we have Form 4797, Sales of Business Property, and Part 1 is definitely necessary for completing Schedule D. We have Form 2439, Notice to Shareholder of Undistributed Long-Term Capital Gains. We have Form 6252, Installment Sale Income. We have Form 4684, Casualties and Theft. We have Forms 6781, Gains and Losses from Section 1256, Contracts and Straddles. And Form 8824, Like-Kind Exchanges, for when you exchange a business or investment property for a similar property. And then you have Form 8997, Initial and Annual Statement of Qualified Opportunity Fund Investments, for investments you made and any deferred gains you have for investments in qualified opportunity zones. So all of the forms that we are showing you on the screen right now, with the exception of Form 8997, are mentioned directly in the line instructions of Schedule D. So you will know where to write the appropriate information. All right, and there are also a few worksheets in the instructions for Schedule D that you may need to fill out if you used one of the forms that we currently have on the screen. And the instructions on the lines of Schedule D also direct you on when to fill out those worksheets. So depending on where you live, you may also need to pay capital gains tax at the state level. This is very important. I want to quickly, Form 8949 is very important, so I want to quickly talk about that before we go into the Schedule D. You need to have Form 8949 first. So how to prepare Form 8949? Any year that you have to report a capital asset transaction, you will need to prepare Form 8949 before filling out Schedule D, unless an exception applies, all right? And Form 8949 requires the detail of each capital asset transaction. For example, if you execute 4 separate stock trades during the year, some of the information you must report includes the name of the company to which the stock relates, the date you acquired and sold the stock, your purchase price, and the sales price. And also, like the Schedule D, there are 2 sections that cover your long-term and short-term transactions on Form 8949. And you then compute the total gain or loss for each category and then transfer those amounts to your Schedule D and then to your 1040. Okay, now one thing I want to say here is that I want to talk about individuals versus the Schedule D. How individuals use Form 8949 and how individuals use Schedule D. So individuals use Form 8949 to report the following. So the sale or exchange of a capital asset now reported on another form or schedule. Voluntary, so we have transactions from involuntary conversions, other than from casualty or theft of capital assets not used in your trade or business. Very important. Non-business bad debts. Very important. Worthlessness of a security, right? We also have the election to defer capital gain invested in a QOF, the disposition of interest in QOFs, and use the Schedule D for the following purposes: to figure the overall gain or loss from transactions reported on Form 8949, to report a gain from Form 6252 or Part 1 of Form 4797, to report a gain or loss from Form 4684, 6781, or 8824. To report capital gain distributions now reported directly on Form 1040 or 1040 SR, line 7. Right, this is basically important to also to report a capital loss carryover from the previous tax year to the current tax year. To report your share of a gain or loss from a partnership as corporation, estate, or trust. To report certain transactions you don't have to report on Form 8949, such as transactions reported to you on a Form 1099B or substitute statement showing the basis was reported to the IRS and for which you have no adjustment. This is very important. And one thing I want to say here is that individuals, estates, and trusts also use a Schedule D to report undistributed long-term capital gains from Form 2439. So now that you have the theory on Form 8949, I want to quickly walk you through. Here are line-by-line instructions on Form 8949. So you can see here you have the form. It's shown on the screen right now. So you have to put the names on your return. You have to put your social, very important. And part 1, you have to delineate the short-term transactions. So short-term means transactions that you have held, transactions involving capital asset you held for 1 year or less. Okay, so on A, you have to check one box here. So A, B, or C. And then in section 1, you have to quickly actually put for every asset. You have to describe the asset. You have to put in B. So A, you have to describe it. In B, you have to put the date you acquired it. In C, you have to put the date you sold or disposed of it. And D, you have to put the proceeds. So you have to be the sales price. E has to be the cost or other basis. And F, you have to put if there is any adjustments, if any, to gain or losses. And H, so G is the amount of the adjustments, and G is the gain or loss. And you have to do this for every property, you have to do this for every asset. In 2, you have the totals. You just have to put the totals, Again, these things, we live in the digital world, so normally this should be done for you automatically by the software, by the tax software you're using. But it is important to understand the mechanics of that so that if anything happens, God forbid you have a CP 2000 notice from the IRS, you're able to respond accordingly. And next we move to part 2. So part 2, as you can see on the screen here, so part 1 was for short term. Part 2 is for long term. And again, long term transactions involve capital assets you held more than 1 year. All right. And it's the same procedure. You have to actually, you need to check one box D, E, or F below, on the screen. Right. And basically you do the same thing. You describe the property, you put the date, acquired date sold, proceeds, the cost or basis. You have to put the adjustment and the gain or loss. And again, you have to do at the end, you have to do the totals. So the Form 8949 basically is a recap of capital asset transactions, long-term and short-term, as well as the totals. And this is the form you will need before you'll need to fill before you start your Schedule D in earnest. Now, let's talk about how to fill out a Schedule D. Now that you know how to fill out 8949 line by line, let's do the same for Schedule D. The totals from Schedule D are transferred to Form 1040, where they are used along with the Form 1040's other data to determine your total annual tax liability. And Schedule D has actually instructions to help you collect information about the current year capital asset sales and prior year capital loss carry forwards. Okay, and you can actually obtain this instructions, as well as blank form from the IRS website as well. So depending on your tax situation, it really depends. Schedule D may instruct you to prepare and bring over information from other tax forms. So Form 8949 that we just talked about, it if you sell investments or your home, that's important. Form 4797 if you actually sell a business property. Form 6252 if you have installment sale income. Form 4684 if you have a casualty or theft loss. Form 8824 if you made a like-kind exchange. This is very important. So let's talk about the Schedule D line-by-line instructions. So I want you to look right now on the screen here. So we have Schedule D, again, very important. At the top, you put your social and your name. And part 1, you have to put the short-term capital gains and losses. So those are, again, generally assets that are held 1 year or less. So 1A, you have to put the information accordingly. You have to put the totals in 1B. And line 2, you have the totals for all transactions reported on Form 8949. So basically, from 1A all the way to 3, line 1A all the way to 3, all that info is coming from the Form 8949 that we just completed. And line 4, you have to actually put the short-term gain, short-term losses if you have filed the forms of 4684, 6781, and 8824, as I just talked about. And so line 5 is the net short-term gain from partnerships as corporations, estates, and trusts from Schedule K1. Line 6 is the short-term capital loss carryover. Okay, now you have to enter the amount if there's any. Line 7, you have the net short-term capital gains or losses. This is very important. So this is basically for the short-term part of Schedule D. And let's now quickly talk about the long-term part. Okay, as you can see on the screen right now, we have a part 2. So part 2, we have long-term capital gains and losses. And it's the same thing. So we have the same strategy here. So line 8A all the way through line 10. You have to bring that data from Form 8949. Very important. Similar procedure. And line 11, again, you have to put some gains from transactions involved in Forms 2439 and 6252, 4684, 6781, and 8824. I think I mentioned that before, what those forms related to. Okay. And now you have to move to line 12 if there is a net long-term gain or loss from partnerships as corporations, estate, and trust from Schedule K1. Line 13, capital gain distributions. Line 14, long-term capital loss carryover. So again, the part 2 is just a similar construction to part 1. Part 1 is just short-term and part 2 is long-term. So you have the same procedures here. So line 14 is a long-term capital loss carryover. And line 15 is the net long-term capital gains or losses. This is where you actually have to combine lines 8A through 14 in column H. Then you have to go to part 3 on the back. So we have part 3 here, as you can see on the screen. I want you to follow with me, folks. So we have part 3. We're showing you part 3 on the screen here. So part 3, line 16. You need to combine line 7 and 15 and enter the results. Remember, line 7 was what? Was the net short-term capital gain or loss. And line 15 was the net long-term capital gain or loss. So you got to combine those two. And if line 16 is a gain, you have to enter the amount from line 16 on Form 1040 SR for seniors, and 1040 NR for non-resident on line 7. Then you go to line 17 below. And if line 16 is a loss, you want to skip lines 17 through 20 below. And if line 16 is 0, then you want to skip lines 17 through 21 below. And you want to enter 0 on Form 1040 SR or 1040 NR, line 7. Then you go to line 22. So line 17 is asking you if lines 15 and 16 are both gains. If yes, you go to line 18. If no, you skip the lines and you go all the way through line 22. So line 18, if you are required to complete the 28% rate gain worksheet, then you will need to enter the amount, if any, on that line. And line 19, if you are required to complete the unrecaptured section 1250 gain worksheet, then you have to enter the amount here. And line 20 is asking you if lines 18 or 19 are both 0 or not. And you have the instructions here, what you have to do. Line 21, if line 16 is a loss, then you want to enter it here and on Form 1040 SR and 1040 NR. So this is basically the loss you're gonna report to the IRS, and that's the loss that's going to actually reduce your tax liability for the year. Okay, and the loss has to be the smaller of the loss on line 16, or $3,000, or if married, filing separately, $1,500. So that's the threshold, and anything above that is carried forward as a loss. It's called loss net operate. It's a loss carry forward. Okay. And line 22 is asking you about your dividends transactions. So if you have any qualified dividends on form 1040, 1040 SR, or 1040 NR, line 38, then you have to either put yes or no, depending on your situation. All right, folks, this is it. This is basically it. So once you do all this, you have to just take that Schedule D and you just transfer that data onto your 1040 SR, 1040 and regular 1040 or 1040 NR, depending on your situation, and that's it. And normally, again, if you use tax software, everything is done automatically, and the data is just transferred from one form to another behind the scenes. You just don't see it. You just file your tax returns. But again, it's great to understand how the whole mechanics work, to understand the whole mechanics, and so that if something happens, the IRS contacts you, you're able to respond. All right. Thank you so much for today's conversation, for your attention. I really appreciate it. I was actually talking to you today about, I was giving you IRS form Schedule D line by line instructions, how to report capital gains and losses. And I spoke to you about when a Schedule D is needed, what is a capital asset, short-term versus long-term capital gains and losses, capital gains tax rates in 2020 and 2021, the net investment income tax, the NIT, how to report capital gains on your taxes, how to prepare Form 8949, how to fill out a Schedule D. And I give you Schedule D line by line instructions. Thank you so much for your attention. Again, I really appreciate it. I will see you next time. But until then, remember, stay marvelous.